Jeff Bezos ran the most valuable company at one point on the entire planet on a salary of about $82,000. That's less than some of our viewers earn each year. So how is he one of the richest people alive? It's not an offshore account and it's not illegal. It's three plain words that the wealthy, they live by and that you're probably hearing more and more on social media. Buy, borrow, die. But most people, when they say this, they still don't understand how it works, and it leads to frustration and anger. There are opportunities where this could actually translate, or some of these skills could translate to the average person. Today, we're going to look at real numbers at today's real rates, and then who this actually works for versus who it bankrupts. The tax code doesn't reward being rich. It rewards owning and holding. Patience and ownership are open to everybody watching. Welcome to the Net Wealth Nest podcast. Okay, so let's actually walk through how this works. First and foremost, you buy. You own assets that grow, and this typically is mainly stock. The key is that the government taxes when you actually sell stuff, not when it grows in value. That unsold growth is what you commonly hear as an unrealized gain. So your stock doubles from 100 to 200, you don't sell, your tax bill is zero. This is the foundation. Then borrow. Instead of selling, which we just said triggers the tax, you borrow against the portfolio with a securities-backed line of credit. SBLOCs, sometimes referred to. That borrowed money, the government doesn't qualify it as income, so there's no tax on it. You spend it without ever earning it on paper. After this, there's one thing that trips up most people. How does the billionaire actually pay the interest on the loan that they took out? How does the loan actually get repaid, especially when it's so big? And the honest answer is they usually don't, at least not with the cash out of their pocket. These line of credits are revolving lines of credit. So most of the lenders, they let you capitalize the interest, meaning instead of writing a check each month or each year, the interest just gets added onto the end of the loan as the loan balance. The loan grows a little on that interest rate. But here's the trick. As long as their portfolio, what they're loaning against, those stocks are growing faster than the interest rate that you're paying, let's say 7% is a pretty conservative rate, and you're borrowing at maybe 4%, the assets are outrunning the debt, meaning you can just keep doing this and doing this and doing this. The loan is getting bigger in dollars, but it gets smaller as a percentage of what you own. Quick pause for a second. If anything I've shared so far has hit a nerve, if you're carrying debt you can't seem to shake, or if you haven't started investing yet, or you're just not sure where you actually stand financially, I built something specifically for that. It's called the Financial Pulse Check. It's 2 minutes, 7 questions, and it'll tell you exactly which money habit is costing you the most right now and what to do about it first. It's free. It's at netwealthnest.com/pulse. Or you could just head over to our website, netwealthnest.com, and you'll see the floating bubble. And I'll drop the link in the show notes for you too. But just take it before you forget. One more time, that's at netwealthnest.com/pulse. All right, let's keep going. So the key is here that the bank will give you a certain amount of a loan depending on how much assets you have. That's called loan to value, and it's a ratio, percentage. And a bank will allow usually anywhere, depending on the type of assets you're holding and what type of stock and all those things, or if it's a different type of asset, they will allow you to take sometimes anywhere between 35 all the way up to 75% of whatever the value of the asset is in a loan. As long as your asset growth is outpacing the loan interest rate, you typically can continue to recycle this over and over and over again. That's what the bank calls a margin of safety. And so they won't ask you to repay the loan, or what's called a margin call. They won't ask you to do that as long as you're consistently outpacing that growth, or over a period of time you are. And as long as you stay under whatever they determine that line is, if it's 35% or all the way up to 75%, as long as you stay under that line consistently, you will never have to repay that and you can continue to operate. You just keep going year after year and decade after decade for some of these individuals until you die. Then there's something called the step-up basis. And that's what erases the game. And that's the magic tax code portion of this. What that means is when somebody really rich ends up taking out these loans and they're using it against the stock they have, their stock continues to grow over, let's say, a couple of decades. The loan continues to do that because that's how they're funding their lifestyle. But they stay within that margin of safety that the bank requires, that loan to value ratio. Then they pass away and that stock is inherited by their heirs. A trigger in the tax code allows a step-up basis, meaning if that stock was originally worth $10 million and now it's worth 30 over a couple of decades, when it's passed on to their heirs, that step-up basis resets the cost at $30 million without doing anything. It's just being passed from one generation to the next. And that's the whole game. Borrow at a lower rate than your assets grow, never trigger a margin call, and never sell. The die portion, since you've never sold, you never pay the capital gains tax on any of that stock growth. You hold it. And then the step-up basis comes in where the heirs inherit the stock and the lifetime of that gains is actually erased as the stock is reset to the cost of whatever it is currently. Then that estate can actually sell a portion of the stock they have to repay the loan and then start the process literally all over again. Unrealized gains aren't taxed. Loans aren't income. And death resets the clock. Okay, so let me show you how the math works in a situation like this. The standard rate today, the Fed rate, it's about 3.5% or so. In big portfolios, let's say a $50 million portfolio, they're going to get a tiny markup. So maybe they're only going to pay, we're just going to say 4% on the loans that they have. And so I'm going to show you how this works each year as you go through. So if we start at year 0, we have 50 million in stock and we're going to take out a $1 million loan. And that over that course that first year, it's going to be about $40,000 in interest that we accumulate. And that's going to be about 1.9%, almost 2% of the total stock portfolio. But as that year went, our stock grew. And so now we're at 53.5, so $53.5 million. We're going to take out another $1 million and we're going to add that 40K that we owe onto the balance. So we're at 2.04 million. And now we're going to pay $82,000 this year in interest, which takes us up to that 3.7%. But again, we're going to roll it all over. So now as we go into year 2, we are going to be at 57.2 million in our stock portfolio. We're going to take out another million and roll over all of our interest into the remainder of the loan. So now we're at $3.12 million. And then over the course of this year, we'll pay $125,000 in interest. And our loan to value has gone up to 5.3% as we get there. And again, this is saying that we're averaging about a 7% growth over this time, which is pretty conservative. And we're saying that the bank will let us get up to 50% loan to value ratio, right? And we just continue to do this as we go through it. So year 3, 4, 5, so on and so forth. Let's flash forward to year 10. Our portfolio has now increased to $98,400,000. So $98.4 million. Our loan is currently at $12.5 million. We've paid about $1.5 million in interest that has just continued. So really what we've borrowed is at year 10, we're borrowing $11 million and we paid about 1.5 in interest, which we've just rolled into the loan itself. And we're still at a 12.7% loan to value ratio after 10 years of doing this. Now, let's say from year 10 to 11, we hit a huge downturn and we lose 30%. We have a bear market, recession, whatever, and the stock market drops 30%. And so we dropped down to $70 million, even though we've taken out another $1 million from year 10 to year 11. So now we're at 13.5, and we've also added on another $540,000 in interest. That still only takes us to $14,040,000 in the loan. And that's currently going to give us about a 20% loan to value ratio, meaning that we still, based on what the bank has said, we still have another 30% that we can move, even though we just lost 30% of our market value. Now, hopefully it goes up after that, which traditionally the stock market does. But you can see how powerful the tool this is, where over the course of 11 years, I've taken about $12 million in cash to use for my lifestyle, however I want, right? Where we've got the 14 million minus the just over 2 million we've taken. It's about $12 million in cash that I have spent over the last 12 years, $1 million a year. So 12 years that I didn't pay taxes on. And now let's say I've done this, I pass away, that it's currently at 70 million. That 70 million, I'm not going to pay any taxes on the difference of what I've grown between the two. My family members are going to inherit that total 70 million at a new cost to them of 70 million. Now, maybe they want to sell the 14,040,000 so they can do that. And then they could start off at what would that be? That would be $56 million roughly that they are starting off at. They didn't pay any capital gains on the 14 million that they sold. And now this loan disappears. And basically what happens is we erase all of this here. All of this goes away, right? And we take that 56 million and now we start at zero at 56 million and whatever our interest rate is going to be. And we start the process all over again. Your rate actually depends on the size of your portfolio, your assets. The bigger amount of portfolio or assets you have, usually the bank is willing to give you a lower rate because they want you to borrow money from them. And they see this huge amount of assets that you could borrow against, meaning that even a small interest rate can generate tens or hundreds of thousands, maybe even millions of dollars over the course of that person's lifetime if they continue to borrow from them. That's a lot of money. And so banks want to see that come through. All right, so let's talk a different category of saver. Maybe the late career saver who has amassed a $10 million portfolio. They're probably going to get a loan rate that is higher than the $50 million. Let's just say it's a 5.5% rate. And they're going to draw down less than the $1 million that the other person did because their portfolio is also smaller. So we're going to say they're going to draw about $200,000 a year. After 10 years of adding all that up, it's about $2.6 million in debt against a portfolio that has grown to $19.7 million. If that individual is disciplined and does a good job not overspending the money that they're withdrawing, their portfolio continues to perform that way, they're probably in a good position with having that out, because at the end of that time frame, they're still under, we'll just round it up to 3 million and 20 million. They're right at 15% and are probably not at risk for anything like a margin call. One key to think about, the stock has to sit in a regular taxable brokerage account. It can't be a pledge of a 401k or an IRA or even home equity. And net worth doesn't qualify you. It has to be liquid taxable assets. So if the bank needs to liquidate the asset to pay the loan, they can very, very easily. Now let's think about the regular person, maybe somebody that saved $500,000 in their portfolio getting close to retirement time. Let's say they want to borrow $100,000 a year. That is already at 20% of what their portfolio is worth. Quite a significant amount just to start off in year one. When I showed you the crash with the portfolio that started at $50 million, even when that dropped down to 70 million, there was still so much room between the loan and how much the asset was worth that the bank wasn't worried about it. But here's where it can make a difference. Let's say there's a 30% crash and that drops that 500,000 portfolio to about $350,000. Now, instead of being 20% of the collateral, the loan is 33%. And if you try to repeat that in year two and take another 100 grand, you're probably over the top of what that loan to value ratio would be, and then hitting a margin call. On top of that, we talked about an interest rate that was 4% for the $50 million borrower. And that allowed them to have that their growth was likely to outpace that. With an asset bundle of about 500, that interest rate is likely to balloon up to 7, 8, 9%, meaning that at best you're likely flat in the interest versus the growth of your portfolio. And at worst, if it goes down significantly, there's a margin call. Margin call means there's no cash to cover it. The bank sells at the bottom. They lock in the loss of all that. You lose the asset and you're triggering any capital gains that you had over the time that you were trying to dodge. It basically detonates a bomb at the absolute worst moment for you. The other thing that many people forget to explain is how the individuals accumulated this wealth, even to begin with, and why this can be so powerful for some of the richest people in the world. Think of some founders and some very rich people. And we'll just use 3 examples. Bezos with Amazon, Zuckerberg for Facebook or Meta, and Elon Musk for SpaceX, Tesla, XAI, all of that. Bezos and Zuckerberg bought founder shares for pennies early before the company was even public. And they never took big yearly grants, paid themselves an average salary as they started out and were building their business. Because the shares were basically next to nothing when they got them, when those companies went public and IPO'd, they were able to actually accumulate all that wealth that wasn't being taxed as their stock exploded and was sold on the open market. So when somebody owns 1 million shares of a stock that they basically paid maybe $1,000 for, because they started the company as a founder, and that stock jumps up to $100, they now have $100 million in worth that is not taxed, is not viewed as income, that they can start to use and start this process that we've been talking about with the buy, borrow, and die. The key is they bought at next to nothing when they bought, and that's why it can be so powerful for some of these founders and business owners over the long term. And so an example of this is Zuckerberg, when they IPO'd, he had a $1 salary. Is literally the gentlest way to get into the tax universe that he could. He had millions of shares of Facebook stock that exploded and made him a 100 millionaire and into a billionaire very, very quickly. And he didn't have to realize any of those gains and wasn't paying himself a regular salary as CEO of Facebook or Meta. Now, the other thing to think about is stock options. And this is a little bit of the contrast with Elon Musk. Now, Elon Musk has actually lived in both these worlds. He's been a founder, but not of all of his companies. So he was a founder at PayPal and he was a founder at SpaceX. But Tesla was different. It was actually founded by 2 other individuals. Musk, in that case, is not the never pays tax story. That Tesla wealth, it came largely from option grants and him having to exercise options. And that is actually taxed at ordinary income, which is going to be a much, much higher rate. And so in 2021, the exercise triggered a tax bill that was reportedly around $11 billion. He sold billions just to pay the tax. And this is something that is very similar to what most people experience when we talk about working for corporations, and they're sometimes given restricted stock units or RSUs. They vest sometimes immediately, sometimes over time, but as they vest and you get to own them, you are charged ordinary income, and that's withheld via a sell to cover ratio. So let's just say that you are going to get 100 shares of whatever company you're working for, and it vests. When it vests, you are either going to owe tax on that when you do your taxes, or what most companies allow you to do is they pull out some of those shares immediately and hold them off, and basically are going to use that to pay your tax bill for you. Very similar to how a company does that when they pay you normally. They normally would pay whatever your hourly rate is or your salary, and they take out the taxes before that paycheck hits your checking account. That is very similar to how some of these stock units or awarded stock programs happen, where they will take a portion of the stocks out before it even hits your stock account, whether it's Fidelity or Vanguard, whoever they're using as the broker to hold those shares for you. They'll take them out and use that to pay your taxes. The thing you got to be careful with here is they don't always pull out enough, because they're guessing what your tax rate could be. If you move up or down in brackets, you could be giving up more than you need or less than what you need, and you might have a tax bill to pay at the end of the year. But this is how the average person gets into this. It's a little bit of a gut check, because you are owning, you're still paying the tax at a higher rate than maybe some of these wealthier individuals that got their stock at next to nothing. Again, the tax code doesn't punish wealth, it punishes wages. And when you get those stocks, they're viewed as wages. It does reward ownership acquired early and held on. So, for example, a janitor and a founder in the same company, they could own actually the same stock. The janitor's stock shares were taxed as wages on day one when they actually received it, whereas the founders were bought for pennies before the company publicly existed. Same stock, just two different worlds. Okay, so the key of this episode is to teach you the background of how this works. It's not intentional to leave you angry and make you feel powerless, although many people do when they figure out how this works. There are parts of the tax code and this wealth universe that are open to everyone. There just might not be the exact same ones. And as we continue episodes in this little mini series, we're going to talk about a few of those. But the really important part is this: the system rewards owning and holding for long term. So do that, own and hold. Long-term bets beat short-term on purpose. Hold over a year and the gains are taxed at a long-term rate, not your short-term rate. The code is literally paying you to try to be patient with your investing. Maxing out your tax advantage accounts, that's your version immediately of the loophole. The other part is, if you have units or stock shares that you're going to get, understand how the tax is handled at best. Traditionally, it's the lower, like a 22% rate. That might not cover the tax depending on what your tax rate is for your normal income. I just say that so you don't get surprised at tax time if that's the case, depending on your income each year. The step-up basis also helps your family too. Long-term holding is a generational strategy, so execute that strategy. The key is, how do you not sell over the long term, and how do you bridge that to your heirs? And that could be anything from stock, that could be real estate, that could be other assets, maybe even a business. All of those things can count and have huge benefits to individuals as it's transferred from one generation to the next. The wealthy ones aren't the only ones the tax code rewards for owning appreciating assets. In our next episode, I'm going to show you how the working person's version of this exact same machine can work for you. You just have to know what the game is that you're playing and how to play it. As always, I hope this was educational and informative for you, and I hope it gives you a little bit better understanding on how the game actually is played, and we'll continue to show you different ways on how to play the game yourself. Thanks again for joining. My name's Jim. Bye, everybody.
Net Wealth Nest LLC and Podcast is an educational platform committed to providing resources and information to empower individuals on their financial journey. Please note, we do not provide financial, tax, or investment advice. All financial decisions should be made in consultation with a qualified professional who understands your unique circumstances. Seeking personalized advice is a smart and necessary step before making any major financial commitments. Thanks so much for joining us today. If you found value in this episode, please like and subscribe to our YouTube channel, Net Wealth Nest, and leave us a review on your favorite podcast platform. We read every comment, and they help us improve and guide what topics we dive into next. And hey, if something you heard today resonated with you, don't keep it to yourself. Share it with a friend, a family member, a coworker, your barber, your barista, even a stranger in line. You never know who might need this message. Remember, building net wealth is a journey, but you don't have to do it alone. Stick with us, and together, let's grow your net wealth nest.